Are you, like many business owners, confused about how to finance your next company car? I'm James Murray, a trusted finance expert and broker with nearly 20 years industry experience, and I'm here to break down the differences between leasing and hire purchasing a vehicle for your business. Now, when it comes to funding a car for your business, you'll encounter a variety of different terms. Some accurate, some misleading, and some are downright incorrect. So to start with, let's just clear up the confusion. Contract hire and hire purchase are legitimate business funding options. Lease purchase and hire purchase with balloon are also valid terms. However, be cautious when you hear PCP mentioned for business finance. Despite being sometimes mentioned, it's not actually designed for businesses. It's in the name, personal contract purchase. In this video, I will touch on the pros and cons of the different funding options for your business. And it's important to remember that each business will have its own unique circumstances. So this isn't to say that one is better than another. Hopefully, I can just help you make a more informed decision. So before we get to the pros and cons, let's break it down into two groups. You have two very different ways in which you can get your next car. The first is called contract hire, and it's also referred to as leasing. Now, it's really important not to confuse the word leasing with lease purchase, as this is a different thing entirely, and I'll explain this shortly. Now, with contract hire or leasing, it's essentially a long-term rental agreement for a brand new vehicle only. Your business pays a fixed monthly fee, and that is to use the car for a set period, usually between 2 to 4 years. And at the end of the lease term, you simply return the vehicle to the leasing company. You don't own the car at the end of the contract, and you won't have to worry about the car's depreciation. Maintenance and servicing can also be included in the contract, which simplifies the running costs and budgeting. So now I'm not going to go into the ins and outs of all the accounting side. That's probably for another video or an accountant specialist, but as an overview, a VAT-registered business using the car exclusively for business can currently claim 100% of the VAT on the rentals. So who is contract hire suitable for? Well, I'd say contract hire and leasing is ideal for established businesses with predictable forecasts seeking monthly payments that are fixed. It's perfect for avoiding vehicle depreciation risks and also suits businesses that are regularly updating their fleets with the latest models. It's also ideal if the company is needing shorter-term vehicle use, such as leasing an electric car to hedge against uncertain long-term value or future technology changes. Now let's look into hire purchase and lease purchase. Hire purchase and lease purchase are very different in their structure, but essentially they are both purchase agreements, and as such, the vehicle appears as an asset on your balance sheet, with the corresponding finance shown as a liability, potentially offering tax benefits through capital allowances and interest deductions. The difference between hire purchase and lease purchase is that at the end of a lease purchase, you have an offset balloon payment. This is also why they call it a hire purchase with balloon. Now, the first significant difference with these agreements over contract hire is that they can be used on new and used vehicles, meaning you have a much wider choice of cars and potential to get a good buy. You also, in many cases, are not restricted to purchasing the car from a main dealer, so independent garages come into play, along with private sales or even auction purchases. Now, typically you pay the deposit, although zero deposits are possible, and then you have fixed monthly payment. And there are variable rate agreements out there as well, but most are done on a fixed rate agreement. And assuming you're on a fixed rate, you will pay fixed monthly payments for the duration of the agreement. Now, these are typically anywhere from 24 to 60 months long, with both hire purchase and lease purchase. With hire purchase, when the agreement comes to an end, you have and you've made all of the monthly payments and any final payments that are due, the vehicle belongs to you. With the lease purchase, there is a final balloon payment left to pay, which will have been agreed at the start, and it will be based on an annual mileage that you set out at the start of the agreement. This means you've had lower monthly payments than the hire purchase option, which may have also helped with your monthly cash flow, but it will have resulted in increased total interest charges and less equity at the end of the term. Now, you're probably thinking, this sounds a lot like a PCP. And it is very similar to a PCP that you get personally, but there's one key difference. Lease purchase does not allow you to hand the car back at the end, which is a popular benefit of the PCP agreements. On a lease purchase agreement, you are liable for any shortfall. So if the car is worth less than the balloon payment, that is your liability. Many businesses still choose to upgrade the car at the end of the agreement, but lots also look to refinance the balloon payment if they plan to keep the car, but don't want to fork out the cash to pay off the final instalment that's due. The hire purchase financing option is ideal for businesses looking to add long-term value to their assets. It suits businesses aiming to build equity in their vehicles, offering the benefit of eventual ownership. HP is also suitable for businesses needing flexibility in vehicle usage without those mileage restrictions. Additionally, it's perfect for companies planning to keep their vehicles for an extended period, providing long-term stability and cost effectiveness. Now, I'd say lease purchase is an excellent financing option for businesses that want that flexibility of lower monthly payments with the potential option of owning the vehicle at the end of the term. It's ideal for companies looking to acquire high-value assets without that significant upfront cost, as well as those that can manage a balloon payment at the end of the finance period. Lease purchase is also suitable for businesses that require vehicles for long-term use, offering the benefits of both leasing and owning, with potential tax advantages on interest payments and depreciation. Now, it's worth mentioning that the last two options do offer a lot more flexibility, but each lender has different terms, and in some cases, the funders do not always offer optimal early settlements for limited companies, as they normally fall into the non-regulated space. There are banks which will either match regulated early settlements or similar preferential early settlement terms, so always check with your broker or finance provider prior to agreeing anything. So those are the three main ways in which you can fund your next company vehicle outside of a cash purchase. And while I can't go into the ins and outs of which one is the best for your specific business, let's take a look at the summary of some of the pros and cons of each. Feel free to take a screenshot of this chart, or alternatively, if you send me your email address, I'll send you over a PDF copy. And what we've got here is obviously the contract hire. We've got pros such as predictable cash flow, avoids depreciation, and lower interest costs, along with maintenance options as well, which you can have included. Cons are things like no ownership, mileage restrictions, less flexibility. Then with the hire purchase, we've got ownership, where you can take the vehicle at the end of the term, you own it outright. Equity, no mileage limits, much more flexibility. Cons on that are potentially higher monthly payments than the other two options, depreciation risk that you're liable for, and of course maintenance costs. Similar with lease purchase, you've also got maintenance costs on the cons there as well, depreciation risks, and there's also a balloon payment which you need to be prepared for at the end of the agreement. The pros with lease purchase being lower monthly payments, you've got an ownership option still, so you've got a flexibility of the best of both. You still get the option of equity, and of course you've got more flexibility than you get with the contract hire option. So I hope this has helped shed the light on this topic. I'm aware that there is another aspect to this, which is the tax implications, but with it being quite nuanced for each business, I'd really recommend you speak with your own accountant on which is the best for your specific business. But hopefully, armed with the knowledge you've just gleaned from this video, you'll be able to make a much more informed decision. I do find that many of the businesses that I work with, they tend to choose varying products depending on their circumstances. And there's a lot more that I could talk to you about on this subject and explain to you, but I'm sure that you've heard enough in this one video. So if you are looking to fund your next company car or fleet of vehicles, or even if you're just curious to learn more, please feel free to reach out to James Murray Finance and we will be happy to help. There's no charge for speaking with us, and we don't charge a fee for any initial consultations, as the banks, they pay us a commission for introducing new business. So you've really got nothing to lose. I'll leave a link to the inquiry page, or just give us a call and myself or a member of the team will be happy to help. Thanks for watching.